Hello, ladies and gentlemen. I salute you all. Welcome to Fenlina Management Consultants. My name is Nathan. The topic for today is cost volume profit analysis with a case study. I'm going to start by giving you a very simple example of an environment where CVP analysis carries a lot of meaning. By CVP, we mean cost volume profit. And CVP analysis simply refers to the analysis of cost and volume, how they influence the profitability of an organization. Take an example of a company that manufactures and sells batteries. You cannot know how many batteries you're going to sell during a particular year. You cannot know the exact price at which you're going to sell the batteries. And all these require experience. So in the nutshell, CVP analysis helps us to sort out such problems while we are at the planning stage, during work in progress, and after. Please remember to subscribe, give the lecture a like, and write your comments below. This will enable us to keep improving our services and communication with you. By definition, cost volume profit analysis is a costing method used to analyze the relationship between cost and volume and how they influence profitability in an organization. Costs can be variable, semi-variable, fixed or semi-fixed as the volumes change with the level of activity. Adjustments have to be made to isolate the variable and the fixed component first before applying the CVP analysis. CVP analysis can be used by companies to determine the level of activity or volume of output that will enable it to make profits, zero profits, which is the break-even point, or losses. CVP analysis is also referred to as break-even analysis. CVP analysis is useful for managers making short-term decisions relating to production and sales. CVP analysis makes several basic assumptions relating to sales price, fixed and variable costs, and activity levels. Break-even point is the quantity or volume of activity needed to be produced and sold, or the amount of sales revenue that has to be generated to cover up the costs required to make the product. We have some basic assumptions in the CVP analysis, and these are as follows. Sales price per unit is constant. Variable cost per unit is constant. Fixed cost is constant. The company produces and sells all its output. In other words, opening and closing stock are regarded as zero. All changes in revenue and expenses occur because of change in level of activity. The general formula for the CVP analysis states as follows. Profit equals sales minus variable cost minus fixed cost. Profit equals sales minus variable cost minus fixed cost. At break-even point, profit is zero. Therefore, sales minus variable cost will give us fixed cost. Contribution margin is what we call sales minus variable cost. The contribution margin represents the difference between the revenue generated for each product or unit sold and the variable portion of the firm's costs. Therefore, at break-even point, contribution margin is equal to fixed cost. Contribution margin per unit times number of units will give us the fixed cost. Therefore, the number of units at break-even point is equal to the fixed costs divided by the contribution margin per unit. Contribution margin ratio is the contribution margin per unit divided by the selling price per unit. By dividing the total fixed cost by contribution margin ratio, the break-even and the contribution margin of 45% must earn a revenue of 444,445. In other words, point of sales in terms of total dollars may be calculated. For example, a company with 200,000 of fixed costs, we divide the 200,000 of fixed costs by the contribution margin per unit to come up with the amount that we are required to calculate, which is, in this case, 444,445. For a targeted profit figure, then the formula becomes contribution margin, which is equal to fixed costs plus profit. For example, the same company needs a profit of 70,000. How much sales revenue is needed? We are just going to use the same formula. We divide 270,000, which is 200,000 plus 70,000, because that's the profit that we need, by the contribution margin of 45%, yielding a required sales revenue of 600,000. Special adjustments. Semi-variable and semi-fixed expenses must be split between variable and fixed components using the costing techniques such as the high-low method, scatter graphs, or regression analysis. This will enable us to isolate the variable and fixed expenses and apply them in the formula accordingly. Importance of CVP analysis. It is used to ascertain and justify for a product to be manufactured on economic grounds. CVP analysis is used to determine the volume of output needed for the business to cover up all production and sales costs and still continue trading or arrive at a desired profit margin. It is also used to determine the margin of safety, which is the difference between the desired or maximum sales and break-even sales. This enables management to assess the production range that will not give rise to losses. We are going to end with a case study which goes as follows. Company A projects its sales price for product X next year at $80 and its variable cost at $50 per unit. Its fixed costs are $330,000 per annum. A. How many units must it produce and sell in order to break even? B. How many units must it sell to make a profit of $250,000? C. Using the same profit margin, what will be its margin of safety? And lastly, what is the significance of the margin of safety? This is the suggested answer. We go back to the formula which says profit equals sales revenue minus variable costs minus fixed costs. Let's call the number of units Q. At break-even point, profit is 0. It therefore means if we input the information in our formula, we are going to say unit selling price minus unit variable costs, put in bracket, times the quantity minus 300,000 equals 0. And from this, we are able to calculate the unit contribution margin times quantity, giving us 3,000. And by dividing by 30, which is 80 minus 50, will give us 10,000 units to be produced and sold. Required profit is 250. We just need to substitute in the general equation, which says profit equals sales revenue minus variable costs minus fixed costs. We are going to say, therefore, that 250 equals unit contribution margin times quantity minus 3,000, which is 250 plus 3,000 equals 80 minus 50, which is contribution margin, times quantity. And therefore, our quantity is going to be 550,000 divided by the contribution margin, per unit, giving us 18,334 units, meaning that for the profitability of 250,000, we need to manufacture and sell 18,334 units. We have also been asked for the margin of safety in units. It is equal to the required units minus the break-even units. And in this case, it is 18,334 minus 10,000, which gives us 334 units. And if we express it as a percentage, it's going to be 8334 divided by 18,334, giving us 45.5%. So the margin of safety can be expressed in units and also in percentage. The margin of safety enables management to assess the production range that will not give rise to losses. In conclusion, CVP analysis is a costing method used to analyze the relationship between cost and volume and how they influence profitability in an organization. CVP analysis can be used by companies to determine the level of activity or volume of output that will enable it to make profits, zero profits, which is the break-even point, or losses. CVP analysis is useful for managers making short-term business decisions relating to production and sales. CVP analysis makes several base assumptions relating to the sales price, fixed costs, variable cost, and activity levels. The break-even point is the quantity or volume of activity needed to be produced and sold, or the amount of sales revenue that has to be generated to cover up the costs required to make the product. Basic assumptions, which you have already mentioned, are that the sales price per unit, variable cost per unit, and fixed costs are constant, that all changes in revenue and expenses occur because of the changes in activity level. All production during the particular period is sold. Semi-variable and semi-fixed expenses must be split between the expenses, which are variable, and fixed components. And lastly, we should not forget our formula of profit equals sales minus variable costs minus fixed costs, and also to emphasize the fact that at break-even point, the profit is equal to zero. This marks the end of our lecture. Please remember to subscribe, give the lecture a like, and write your comments below. This will enable us to keep improving our services and communication with you. Thank you very much, and may God bless you.